This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
In our first session on CGT reliefs, we saw how it was that entrepreneurs' relief would be available and allow certain qualifying business asset gains to be only taxed at 10%, rather than the alternative 18%, or more likely, as we suggested, 28%. Clearly, a most beneficial relief, allowing taxpayers who run their own businesses to look forward to the day when they dispose of that business about not being hit with a huge tax charge, a mere 10%. But we also made the point that that relief was only available so far as the individual was concerned when the trade, the business, was sold, or indeed an identifiable part of that business. If all we did was to merely sell an asset that we used in the trade, for example a property, then any such gain would not be eligible for entrepreneurs' relief. But now we come to Section 2, Replacement of Business Assets, and a relief that we'll know as Rollover Relief. That if we do indeed dispose of an asset used in the trade, principally a land and building asset, a property there used within the trade, and as long as we replace it with another qualifying business asset, i.e. the usual scenario is we sell one property and we buy another, it's usually a replacement scenario, then if we do that and we reinvest all the sales proceeds from the sale in the acquisition cost of a new replacement property, a new replacement business asset, then the gain arising on the disposal will in fact be eligible for deferral. Now, we won't be able to exempt that gain, but we will be able to defer it. And it's called rollover relief here, because what we do in terms of achieving this deferral, the gain is deferred by deducting it from the acquisition cost of the newly acquired asset. Now, you think if for CGT purposes we reduce the base cost of the newly acquired asset, what will happen when that asset in turn is eventually sold? With a lower cost, then the gain will be that much higher, and at that point that gain will then crystallize. Well, I say at that point the gain will crystallize. What of course could happen when that asset is indeed eventually sold? It could be replaced by another. And so long as when we sell these qualifying business assets, again 99% of occasions properties used in the trade, as long as we reinvest all the proceeds in another qualifying business asset, again usually the replacement property, then we will be able to continue to defer those gains. The only time any gain will crystallize and therefore be charged, be taxed, is at a point when we fail to reinvest any part of the proceeds, such as we'll see in this section of the notes. So let's, having had that introduction, look at the detail now within the notes. Definition. A gain may be rolled over, as we have just said, which means deferred, where it arises on the disposal of a qualifying business asset. We'll see here that the main qualifying business asset, land and buildings used in the trade. Again, a presumption here, used in the trade. If any part of an asset is not used in the trade, then not all of that gain will be eligible for relief, but we'll see that in a subsequent section after dealing with these basics of rollover relief. There is another qualifying asset, what we refer to as fixed plant and machinery. There are in fact several other categories of qualifying business assets, but only these two are within the syllabus so far as F6 is concerned. Again, as we've said, both the old and the new assets must be used in the business there. The usual situation, we sell a property and we reinvest the proceeds in another property. And that was the point when we have the disposal of the qualifying business asset, the sale proceeds are reinvested in another qualifying business asset. How does the relief work? Well, as we suggested, the gain is deferred, so it's not taxed immediately. So it's not exempted, it's merely deferred. It is postponed until the trader makes a disposal of the replacement asset without further replacement. whenever you fail to reinvest the proceeds following a disposal, then that is when any part of the gain may become chargeable. How does this deferral, this postponement work? Well, as we suggested, it is achieved by deducting the gain made on the old asset from the cost of the new one. So by making, therefore, the cost lower on the new asset when it is sold, that of course will mean that the subsequent gain is larger. Now let's illustrate this with a simple basic example. So if we could make a note of the following information, therefore. We're told taxpayer sold a business used in her trade, so the building is used in the trade there, and she sold this building for £500,000. She sold it on the 1st of December 2015. Now we will be interested in the relevant dates of the transactions. When was the qualifying business asset sold, and when did we purchase the new qualifying business asset? There is indeed, as we'll see back in the notes, a time limit in relation to when the two transactions must occur in order to allow the relief to be available. And purchased a replacement property, so again a property, a qualifying business asset, in January 2016. Now, as we'll discover when we read the note, this is well within the available time scale for the reinvestment to occur. No need for you to note it now because it's on the notes that we'll look at in a few minutes' time, but as long as the reinvestment occurs between 1 year before the disposal and up to 3 years after the disposal, then we will be eligible to make a claim for rollover relief. So there's what we might call a 4-year window of opportunity in which to make the reinvestment. That 4 years running from 1 year prior to disposal to 3 years after disposal. Now here we can see that the acquisition was in January 16, the next month. Very easily, therefore, within that 1 year before to 3 years after the disposal period of time. As well as looking to see whether the reinvestment has occurred within the relevant timescale, which it has, we then need to see whether all of the proceeds were 500,000, have been reinvested. And of course they have, at a cost of £600,000. What that means is, if we make a rollover relief claim for any gain arising, that what we'll call full rollover relief will be available, i.e. the entire gain may be deferred. Once we've done this example and returned to the notes, we'll see what would happen if the replacement one had cost less than those proceeds of £500,000. But here, not a problem, it's full rollover. So we need to be able to work out the gain on the disposal of the old property. Simply enough, that building had been purchased in October 2012 at a cost of £350,000. Right, simple calculations therefore to show what is happening here. First of all, calculate the gain. So our sales proceeds, £500,000. The cost, £350,000. Simple calculation therefore of the gain. The gain will be £150,000. If we make our claim for rollover relief, we said it will be a claim for all of the gain to be deferred. Full rollover is available. Why? Because we've reinvested all the proceeds. We sold for £500,000, we bought for £600,000. Therefore, the rollover relief, as it is known, would be the full extent of the gain of £150,000, bringing us down therefore to nil chargeable gain. So none of that gain would be chargeable. Now this is a very sensible relief. What HMRC, what the government would wish to do is to encourage businesses to expand. It is good for the economy if they indeed are able to expand. So if we sell one qualifying business asset, reinvest all the proceeds in another, it would be foolish and very short-sighted to tax that gain now, if that therefore inhibits the investment decision about being able to grow that business. So it's a sensible policy on the part of the HMRC. They're recognising that a chargeable disposal of a chargeable asset by a chargeable person has occurred. But it would be silly of them to charge that gain now if in fact it meant that it put off businesses, individuals from expanding that business operation. So the gain is deferred, and how is that deferral process worked? It is by reducing the base cost of the newly acquired asset. So the deemed cost for tax purposes of the new building, that will be simple enough to compute. What was the actual cost? We bought it for 600,000. What is the rollover relief? 150. So we deduct 150,000, giving us therefore a revised base cost of £450,000. So when that building is eventually sold, in its gains calculation, rather than using the actual cost of 600,000, we will use for tax purposes the deemed cost of 450. So very clearly that future gain will be bigger by £150,000. But as we have said, if on that occasion too, whenever it is, however many years from now, if we reinvest all those proceeds within the relevant time scale and claim rollover relief, then that gain will also be eligible for deferral. The only time, as we'll see soon, when any part of any gain arising will crystallise and therefore face immediate chargeability is where we fail to reinvest all of the proceeds. Okay, let's have a little look back therefore at our notes now. Take you back to that. We have just said about the timescale in which the reinvestment must occur. There you go, note D. The replacement asset must be bought in the period 12 months before to 36 months after the disposal, from a year before to 3 years after. Now it might seem odd about reinvesting the proceeds from a disposal up to 1 year before that disposal has occurred. But if you think about it in reality, although I gave you a simple example a moment ago, we sold in December, we bought in January, that actually in reality, if you're running a business, you can't do without your business property for any period of time at all. You can't sell the old one and then say, right, let's go find a new one, therefore, put all the plant and machinery, fixtures and fittings and everybody into a truck and we'll go find a new one. It doesn't work that way. So the probability is that we will indeed have purchased the property, the replacement one, prior to the actual disposal of the old property going through. On that basis, therefore, it is sensible that we're allowed up to 12 months before, as well as up to 3 years after the disposal, within which to make the reinvestment. You've then, as well as having plenty of time to make the reinvestment, got plenty of time in which to make the claim. The claim must be made within 4 years from the end of the tax year in which the disposal occurred. So any disposals in our 15-16 tax year, ending the 5th of April 16, 4 years will take you to the 5th of April 2020. So plenty of time in which to make your mind up. Again, usually, of course, we will have made our mind up much sooner than that. Indeed, if you make a disposal in 15-16, then any tax that would be chargeable on a gain would be payable, of course, at the following 31st of January. There, for us, the 31st of January 17. So it's probable that by that date, of course, we'd have made our mind up as to whether or not to make this claim to defer the gain. What we've seen so far is where the disposal proceeds of the old asset, coming to note C now, were fully invested. But what happens if the disposal proceeds of the old asset are not fully reinvested? Then the surplus retained reduces the amount of capital gain that can be rolled over. This is going to be partial rollover. Now, it's a simple exercise to perform, and to perform that, let's just go back to the example we saw a moment ago. Now, back in this example, remember, we had sold for £500,000. We will stick with that. That one had been bought for 350, and therefore we've still got a gain of 150,000. But what we now discover is that instead of reinvesting all the proceeds as we did where we had bought for £600,000, let's now assume that we had bought for something less than our proceeds. So let's say that we bought for 450,000. So let's now assume replacement property cost 450,000. So assume that our new building, assume that the new building cost £450,000. So how would we deal with it? Well, you'd still have exactly the same calculation of gain. We sold for 500, we bought for 350, the gain hasn't changed, it's £150,000 worth of gain. What changes is the amount of rollover relief that will be available. Because we failed to reinvest all of those proceeds, then some of that gain will remain chargeable. There will remain a chargeable gain. And it's actually that chargeable gain that we compute, and the rollover relief then is simply a balancing figure. And the reason why some of the gain arises that is now going to crystallize is because we failed to reinvest all the proceeds. And that is all you've got to look at. How much of the proceeds did you fail to reinvest? So how much did we sell our property for? We sold for 500. How much did we buy for? We bought for only £450,000. What does that mean? It means that we've taken out on this deal £50,000. If you've got that cash in your pocket, you failed to reinvest, then that amount of the gain remains chargeable. So you work out here, when dealing with partial rollover, how much of the gain remains chargeable. And it's a simple comparison of two numbers. What did we sell for? What did we buy for? If we fail to reinvest all the proceeds, that amount not reinvested is immediately chargeable. So if 50,000 of the 150,000 gain is to remain chargeable, what will that leave as eligible for deferral in the form of rollover relief? That balancing figure is £100,000. What will that therefore make the deemed cost of your new building? What was the actual cost? 450. What is the rollover relief, the deferral? 100. Therefore, as ever, deduct the rollover from the base cost of the newly acquired asset to get the deemed cost for tax purposes. That will therefore be £350,000 to use when that property is itself in the future disposed of. What has actually cost you £450 will be deemed to have a cost on a future disposal of just £350,000. So we should now be able to deal with either full rollover or partial rollover. Just one thing to add from a planning and advisory perspective to your client here. Wherever you see partial rollover, such as we see here, that is not the end of the story. What we've seen is that for rollover relief to be available, reinvestment must occur between what time or within what time scale. It runs for that 4-year period from 12 months before the disposal date through to 3 years after the disposal date. Now, our disposal date in this example was December 15. It was sold, was that the 1st of December? What did I say? Let me just go back and check for you there. Yeah, sold on the 1st of December 15. So, it was sold 1st December 2015. The immediate acquisition that we have seen was in January 2016. But we have got up to 3 years after the disposal date in which to make reinvestments. So that means if we sold on the 1st of December 2015, we would have all the way through to, that would be the 30th of November of 2018. As long as we buy before the 1st of December 18, 3 years on from the sale date, then rollover relief would be available. And the point here about rollover, it's not simply where you have, which is, I've got to say, the situation you're most likely to see and the one we've seen here, it's not just about a direct replacement of a property used in the trade. It's not necessarily just a one-for-one. Now, we've seen here that we sold a business property and we bought another one, but we failed to reinvest 50,000 of the proceeds, causing 50,000 of the gain to be chargeable. But if prior to the 30th of November 18, another qualifying business asset were to be purchased for at least £50,000 or more, then a further claim for rollover relief would in fact be available to you. So wherever you have partial rollover, if you're dealing with a discursive question, a section C, a narrative, a written question, and you're asked to advise the taxpayer over the implications of the sale and purchase, you would do the calculations that we've just done, calculate the gain of 150, show the immediate deferral, but it's limited to 100,000, and say that at this point there would be immediate chargeability of the £50,000 gain, and the new property would have a base cost deemed to be 350. But you would also make the comment that if before, within 3 years of that disposal date, so by the 30th of November 18, the further £50,000 were to be reinvested in any other qualifying business asset. It might be an extension of the property, we might buy another property, a separate one, we might buy some fixed plant and machinery. That if that were to occur, further claims for deferral would be available to you. Okay, so we've now dealt with full rollover and partial rollover. Again, just looking at the notes that we've got here, we've dealt with all bar one of them. Rollover relief is available on the sale of an individual asset, where we've seen, of course, that entrepreneurs relief would not normally be available. Only where we get the whole business being sold would entrepreneurs relief be available. But if you did have the business being sold, then rollover relief could still be claimed on any part of the gain qualifying, so a qualifying business asset, and then any remaining part of that could be eligible for entrepreneurs relief. It would assume, of course, that having sold one business, that you're going off and then setting up another business and again purchasing qualifying assets. So if you wanted to, rather than immediately being taxed using entrepreneurs relief at 10%, that gain could still be deferred so long as the reinvestment has occurred between the year before to 3 years after the disposal date. Okay, having looked at those exercises, therefore, I'd now like you to pause this particular lecture at this point and have a go at the following examples. There, example 3, Jones purchased a property for £250,000, sold the property for £300,000, and then spent £320,000 in July 15. We'd sold in August 15, so again we had purchased prior to disposal, a usual situation. Calculate the gain to be deferred and the base cost of the new asset. You should be able to identify, I hope quite easily, what type of relief that is, and how to deal with it. Then move on to example 4. Jerome bought a factory for $680,000. He wished to move to a more convenient location, sold the factory for $800,000, so easy enough to calculate the gain, then moved into a rented factory until January 2016, when he purchased, and it's at that point that rollover would become available. Calculate the base cost of the new factory if it was purchased for $750,000, $600,000. Look at what is different now. We sold for £800,000. Therefore, in both of those scenarios, we are reinvesting less than the full proceeds. So I'd like you, therefore, to do both example 3 and example 4, if you'd be so kind. Now, we've made the point that for rollover relief to be available here, that we must be disposing of and reinvesting in a qualifying business asset used within the trade. So the next section we now look at is, well, what would happen if there was some non-business use element of the qualifying business asset concerned? So section 2.4 here, note A to begin with. Full rollover is only available, as we know, where the asset being replaced was used entirely for business purposes throughout the trader's period of ownership, and of course is then replaced with another qualifying business asset used for business purposes. So where this condition is not met, rollover relief is limited in proportion to the business use. It's a pretty familiar issue, isn't it, in taxation, where we get a mix between business and non-business use. Then we will limit to the business use element. So effectively, it's usually a property that we're talking about here. The asset is treated as two separate assets. One that does qualify for relief, i.e. the bit used in the trade, and another that does not. Okay, let's have a go therefore at our example 5 to illustrate what's going on. Again, normal requirements when dealing with disposals and the potential for deferral rollover. What is the chargeable gain arising on the disposal in July 15, and what then will be the base cost of the new factory? So Jake, we're told, purchased a factory in May 91 for £540,000. Now here's the reason why it's not all used in the trade, and why normally it's property that of course we'd be dealing with. Because he let out 15% of the factory. So that therefore is effectively an investment use rather than a trading use, and that means that any part of the gain attributable to the non-business use component is not going to be eligible for rollover. In July 15 he sold the factory for £600,000. So easy calculation to begin with before we go on and deal with the rollover issue. What gain arose? So we sold for £600,000, cost £540,000. So a simple enough calculation of our gain. Sales proceeds, 600,000, and our cost, 540,000. Take it away, and of course we're looking at a gain of £60,000. But not all of that gain is going to be eligible for rollover relief. So what will be the gain eligible for relief? Well, we've got 15% being let out, so 15% of that £60,000 is immediately chargeable. No matter what happens in terms of any reinvestment, 15% of that gain will not be eligible for relief because it's to do with an investment asset rather than a trading asset. So we therefore will only have 85% of the 60,000. And what's that going to be? Well, 15% would be 9, so that must be £51,000 will be eligible for rollover relief. 9,000 is immediately chargeable, whatever else happens. The next issue then is, well, what about rollover? Can you actually roll over all of the 51 that is eligible for rollover? So now we've got to look at the amount of the proceeds being reinvested. Now here we look at the business component. So what is the business proportion of the sale proceeds? We sold for 600,000, so times 85%, that was the business element, and it is that would have to be reinvested. Now, as we can see from the information in the question here, we bought another factory for £650,000. Now again, if there was any private use or non-trading use, I should say, of that, if some of it was being let out, then you'd need to know what was the business element. And you compare your 600,000 at 85%, what's that going to be, £510,000, with whatever the business proportion, the business use of your new one was, and multiply that by 650. Here, of course, there's no indication that any of the new factory is being let out, so you've got 650 reinvested. So 510 was the net proceeds from the business use element of the old property. You bought for 650, you've reinvested all the proceeds, so yes, the rollover relief now available will be £51,000. What do you do with rollover? What do you do with the 51,000? You deduct it from the base cost of the newly acquired asset there. So the deemed cost, 650 minus 51,000 will be what? £599,000 there would be the deemed cost of the new factory. Okay. Again, have a look through now the answer in the back if you need to back up what we have just said as regards the answer to that problem. And then again come back to us and we'll continue on and attempt then to finish off our studies of rollover relief. Well, the last of the areas that we need to review when looking at this relief is a slight variation on the theme. We know that for deferral in the form of rollover, we have to have the disposal of a qualifying business asset and the reinvestment of proceeds in another qualifying business asset. You may recall that one of those qualifying business assets we referred to went by the name of fixed plant and machinery. Fixed means immovable there, something like a crane system that you might operate within a warehouse, for example, would be an example of fixed plant and machinery, something that you can't move around. Now, if we had a reinvestment in such fixed plant and machinery, then we have a very special name for that type of qualifying business asset. It's known, as we'll see here, as a depreciating asset. And a depreciating asset is one defined as one with a life of no more than 60 years. An asset with an expected life of a maximum 60 years. Now, fixed plant and machinery is always deemed to have such a life, one of not more than 60 years. So automatically, fixed plant and machinery will be taken to be a depreciating asset. What other type of asset might we see? Well, we've been dealing in terms of pure rollover with properties. But what we have assumed up until now is that the property being sold and the property, more importantly, being purchased is in fact a freehold property, one that we own forever, rather than one for which we only have a leasehold interest. So, an asset with an expected life of a maximum 60 years, what we might see, in addition to fixed plant and machinery, would be a leasehold property with a life of no more than 60 years. Indeed, those are the only two categories of asset here, depreciating asset, that we need to be familiar with so far as the syllabus is concerned. So, back in the examples we've been looking at, imagine that we did sell a freehold property. You know it's simple enough as to how to calculate the gain, and based on what we were looking at a few minutes ago, you could then even work out how much of that gain was eligible for rollover in terms of if there had been some non-business use, only the business use proportion would be available. So we can work out the gain on the disposal eligible for deferral. That deferral up until now has been rollover. But imagine that the property now being purchased was a leasehold property that had no more than 60 years to run. So you acquired a 45-year lease, for example. Now that new asset acquired would be a depreciating asset. And if the new asset is a depreciating asset, then although the deferral will work in the normal way, in as much as if you reinvest all the proceeds, you'll have full deferral. If you reinvest just some of the proceeds, then the best you can hope for is partial deferral. That deferral is dealt with slightly differently. We do not have what we would construe as being rollover. We do not roll over the gain against the base cost of the newly acquired asset, i.e. here the 45-year leasehold property. The gain deferred is not deducted from the cost of the new asset. But the immediate impact is the same. The gain is deferred. But this time it's deferred until the earlier of these three events. Now this again is something which by exam date you need to have learnt what these three events are. Familiarise yourself with them now, but again it is a learning exercise. You'll need to know them walking into the examination room. So what is it that happens in the future that could cause the now deferred gain to crystallise? Well, I think the first one would be the most obvious and the most likely, and that is you dispose of the new asset. So you sell that 45-year leasehold property. That would then cause the deferred gain to crystallise. Or, less likely, the date that the new asset ceases to be used in the trade. So that 45-year leasehold property, you stop using it in the trade, you let it out, for example. That would cause the deferred gain to crystallise. Or there is a maximum time period 10 years after the new asset was acquired. 10 years after that, if you still own it, you're still used in the trade, then the deferred gain will crystallise. So you do not reduce the base cost of that new asset, either that fixed plant and machinery or that leasehold property. You do not roll over. We sometimes use the expression here that we may hold over this gain, but it is a deferral until the earlier of those three events. Again, as we know, entrepreneur's relief is only available if any remaining gains after the relief are in relation to the disposal of the whole business. You only get entrepreneur's relief, and remember, that doesn't stop the gain being taxed. It simply reduces the tax rate down to 10%. But that's only available if we're talking about the disposal of the business there, an identifiable part of the business. All right, let's just have a little go at example 6 here. Charles purchased a freehold factory, May 91, for £300,000. June 14, sold for £500,000. So a simple enough calculation, therefore, in relation to the gain. We've got a £200,000 gain now arising. And in July 14, bought a 55-year bought a 55-year leasehold factory building for £600,000. So it's a 55-year leasehold factory. 55 is not more than 60. That means that this is a depreciating rather than a non-depreciating asset. That means that although we may have a deferral, and we can see that the building was purchased for £600,000 there, we have therefore reinvested all of those proceeds, so a full deferral will be available to us. That deferral will be in the form of this holdover rather than rollover relief. In February 2016, Charles sold the leasehold factory for £640,000 and moved into rented premises. So here there are two events that we need to deal with. Back in June 14, the freehold factory was sold. That factory was sold for £500, bought for £300. There was a gain of £200,000 that arose. Because in July 14, we bought the 55-year leasehold factory for £600, we had reinvested all of those proceeds. That meant that the entire gain of £200,000 would be deferred. Deferred until the earlier of three events. and it would appear that the earlier of those three events has occurred quite soon thereafter. In February 2016, Charles sold the leasehold factory for $640 and moved into rented premises. Calculate the chargeable gains arising in 2015-16, assuming that Charles had claimed to defer gains where possible. So, you have a little think about that now. We know that as a result of the sale in February 2016, the gain that had been deferred of $200,000 will then crystallise. It will then crystallise. But there is also a further gain arising in relation to the leasehold factory as well. The leasehold factory was sold for $640. It had been bought for $600. Remember, with this holdover relief, you did not reduce the base cost of that leasehold factory. So that base cost remained intact at $600, sold for $640. You have a £40,000 gain. Now, it is not to say, of course, that there may not be a further claim in relation to rollover. Remember what the window of opportunity is in relation to rollover there. So we may, as we'll see in a moment, get a further opportunity to defer any parts of these gains. We will see. But at the moment, in 15-16, we've got the crystallisation of the deferred gain following the holdover relief in relation to the freehold factory sold and the leasehold being purchased, a gain of $200,000. We've also got the gain on the disposal of the leasehold factory itself, £40,000. Okay, have a little check through and read through the answer to that again in your course notes at the back. Before then, we'll deal with just one final small issue. As we said, just one final point here in section 2.8, that is the acquisition of a new non-depreciating asset. We said a moment ago that following on from the disposal that had occurred of the leasehold factory, two gains arose. We had the gain itself in relation to the leasehold factory, some $40,000, and the crystallisation of the earlier deferred gain due to having purchased that depreciating asset. Well, what might happen in between times is that a new non-depreciating asset, something like a freehold property, may be acquired before the deferred gain becomes taxable. If that were the case, rollover relief could be claimed instead. So if prior to the crystallisation of the deferred gain in relation to the depreciating asset, you were to have bought a new non-depreciating asset, what you can do is take what had been held over and instead then roll it over against the base cost of the newly acquired non-depreciating asset. The classic scenario, you go from freehold to leasehold of no more than 60 years, you hold over. And then before the gain crystallises on the earlier sale of the freehold, you buy another freehold. And what that means is that what had originally just been held over could now be rolled over. So the capital gain on the original asset is rolled over into the new non-depreciating asset, and the depreciating asset for that purpose is effectively ignored within the deferral process. Again, not likely, just a little add-on as an awareness, just in case again in, say, section C, you've got a discursive question and you're asked to deal with the acquisition and potential subsequent disposal of a depreciating asset. You could just add in that, again, it would be possible that what had only been held over could effectively be rolled over if you went back into and purchased a new non-depreciating asset prior to the crystallisation of that deferred gain. Okay, that brings us to an end of this particular session, therefore, in relation to the second of the major reliefs that we need to know within our syllabus, rollover, and within that the concept of holdover relief. That relief, in point of fact, the rollover stroke holdover, is the only one of the reliefs that we deal with within this chapter that is actually eligible for companies. In corporate tax, this relief, rollover/holdover relief, is the only relief that we will see that will be available in corporate tax. All of the other reliefs that we see here, entrepreneurs relief that we have already seen. What you can see here on the page in front of you, we'll see in our next session together, reliefs for the gifts of business assets, i.e. gift relief there, is only available to individuals. And finally, the last of the reliefs we look at, principal private residence relief, again, clearly only available to individuals. So the only one of the reliefs available in corporate tax, don't worry, you'll be reminded of this and we'll do examples on it in our corporate tax chapters, will be rollover/holdover. Okay, that brings this chapter to a close, therefore, sorry, not this chapter, this particular lecture to a close. And as we said, in our next session together, we'll be picking it up and dealing with the so-called gift relief.